On a night in early 1987, auditors from Pete Marwick, Maine completed their physical inventory count at the Crazy Eddie store in Edison, New Jersey, and went home. The count sheets they left behind recorded the merchandise that was actually on the floor and in the back room that evening. After the auditors were gone, store staff trucked in additional merchandise, and the count sheets were revised upward so that the figures the auditors had certified would reconcile to a number that the company needed to report. The auditors had counted reality. By morning, reality had been adjusted. The question this episode answers is structural. An independent audit of physical inventory is supposed to be the one control a fraudster cannot defeat, because it does not rely on the company's records. It relies on observation. So how does a company corrupt a count that outside professionals performed with their own eyes? The answer at Crazy Eddie was not a single forged document. It was a system, a coordinated set of techniques for inflating inventory, fabricating sales, and moving money in a way that made each fraudulent number support the next. The record establishes how that system worked, and it establishes why it took years to come apart. This is money power fraud. The case is Crazy Eddie, Inc. Begin with the legitimate mechanism, because the fraud is a distortion of something ordinary. Crazy Eddie was a consumer electronics retailer. It sold televisions, stereos, and audio equipment across stores concentrated in the New York metropolitan area. Like any retailer, its profitability depended on the relationship between what it paid for inventory and what it sold that inventory for. And like any retailer, the single largest number on its balance sheet was inventory itself. The merchandise sitting in stores and warehouses waiting to be sold. Inventory accounting follows a basic identity. Beginning inventory plus purchases during the period minus the cost of goods sold equals ending inventory. Rearrange that identity and you see why inventory is the most sensitive number in a retailer's financials. Cost of goods sold equals beginning inventory plus purchases minus ending inventory. If you overstate ending inventory, if you claim there is more merchandise on hand than there actually is, you mechanically reduce the cost of goods sold. And reducing the cost of goods sold mechanically increases gross profit. Inflated inventory does not just make the balance sheet look healthier. It flows directly into the income statement as fabricated earnings. This is the central vulnerability the Crazy Eddie scheme exploited. Inventory is where the balance sheet and the income statement meet. $1 of phantom inventory is $1 of phantom profit. Now, the control that exists precisely to prevent this is the physical inventory count. At the end of a fiscal period, the company counts what it actually has. Auditors observe that count. They select items, count them independently, and trace the counts into the company's records. The premise is that you cannot inflate inventory if an independent party physically verifies how much exists. The count is supposed to be the floor beneath the entire edifice of inventory accounting. The record establishes that Crazy Eddie attacked that floor directly and from several angles at once. The first technique the SEC's enforcement record describes is the inflation of the physical count itself. Count sheets were altered after the auditors had observed the count. Merchandise was moved between locations the auditors had already visited and locations they had not yet reached, so that the same goods could be counted more than once. And, as the cold open describes, merchandise was brought into stores after auditors departed, so that subsequent reconciliations would tie to inflated totals. The auditors were counting honestly. The company was manipulating the conditions of the count around them. The second technique involved what the record refers to as debit memos. A debit memo in legitimate retail accounting is a document a retailer issues to a vendor to claim a credit, for defective merchandise returned, for advertising allowances the vendor agreed to fund, for volume rebates owed. It reduces what the retailer owes the supplier or creates a receivable from the supplier. Recorded as income, a legitimate vendor credit is real. The record establishes that Crazy Eddie recorded debit memos for credits that the vendors did not owe and had not agreed to. These fictitious debit memos inflated income directly, and they inflated the assets associated with amounts supposedly due from suppliers. The third element is the one that gives this episode its title, and it is the most structurally interesting, because it connects the fraud to the cash. Before the company went public, the record establishes that the Antar family had for years engaged in skimming, taking cash sales out of the business before they were recorded to evade taxes. The money went into accounts the family controlled, including funds moved abroad. Here is the structural pivot. Skimming and inventory inflation point in opposite directions. Skimming understates revenue and profit, which is what you want when you are evading taxes on a private company. Inflating inventory overstates profit, which is what you want when you are selling stock to the public at a multiple of earnings. Crazy Eddie did both, in sequence. It suppressed reported profits while private to minimize taxes, and then, as it prepared to go public, and after it went public, it reversed course and inflated profits to support the stock price. The previously skimmed cash became a resource. It could be brought back into the business and recorded as sales, manufacturing revenue growth that had no underlying commercial transaction. That recycling of previously diverted cash back into recorded sales is a form of lapping. In its classic definition, lapping is the concealment of a shortfall by applying a later receipt to cover an earlier one, rolling the gap forward so that no single account ever appears short at the moment it is examined. Crazy Eddie's version operated on the same principle at the level of the whole enterprise. Money that had been taken out was fed back in to make the present period reconcile with the imbalance perpetually rolled forward into the next count, the next quarter, the next audit. The store that restocked its own shelves after the auditors left was performing, physically, the same maneuver the cash performed financially, covering a gap that existed only because the company itself had created it. Now, the architecture. Walk through how these pieces fit together into a machine, because the individual techniques only generated reliable fraudulent earnings when they were sequenced. Step 1. The cash was taken out before the company went public. The record establishes a years-long pattern of skimming unrecorded cash sales. This served the immediate purpose of tax evasion, but it also created a pool of off-the-books funds outside the company's recorded results. That pool mattered later. Step 2. As the company prepared its initial public offering, the skimming was reduced and then reversed. The SEC's enforcement record establishes that in the period leading up to and following the offering, the family reduced the amount of cash skimmed, which by itself made reported profits rise, because revenue that had previously been diverted was now recorded. A reduction in skimming looks, on the income statement, exactly like organic growth. The same store, the same sales, but more of them recorded. To an outside analyst building a model from the financial statements, this appeared to be a fast-growing retailer with accelerating same-store sales. Step 3. The previously skimmed cash was brought back into the business and recorded as additional sales. This is the recycling step. Funds that had been diverted were returned through the registers or otherwise injected and recorded as legitimate revenue. The record describes amounts being transferred back into the company and recorded as income. This created the appearance of growth that the underlying retail operation was not generating, and it did so using money the company had effectively pre-funded by skimming it years earlier. Step 4. Inventory was inflated to support the margins. Recording phantom sales is not enough on its own, because phantom sales without corresponding cost of goods sold would produce impossible margins, and impossible margins draw scrutiny. To make the income statement internally coherent, the inventory account had to be overstated. The physical count manipulation and the fictitious debit memos served this function. Overstated ending inventory reduced recorded cost of goods sold, which both increased gross profit and made the relationship between sales and margins look plausible. Step 5. The audit was navigated, not defeated, through manipulation of the conditions of verification. This is the core of the architecture. The auditors did real work. They observed counts. The record establishes that company personnel altered count sheets after the auditors had left, moved inventory between stores and warehouses to be double counted, and brought merchandise into locations to inflate the totals against which reconciliations were performed. The fictitious debit memos were prepared as documentary support for income the auditors would otherwise have questioned. Each control the auditors applied was met with a specific countermeasure designed for that control. Consider how these steps reinforce one another. The inflated inventory supports the fabricated sales by keeping margins plausible. The fabricated sales, funded by recycled skimmed cash, support the reported growth story. The growth story supports the stock price. The rising stock price increases the value of the family's holdings. And the manipulated audit certifies the whole structure, lending it the credibility that allowed the public markets to accept it. The record establishes the scale of the inventory overstatement grew over time. As public company pressures intensified, the gap between reported inventory and actual inventory widened, because each period's fabricated earnings raised the baseline that the next period had to exceed. This is the lapping dynamic at the enterprise level. Once you have recorded phantom inventory and phantom sales in one period, the following period inherits that inflation as its starting point and must add to it to show continued growth. The shortfall does not resolve. It rolls forward and compounds. There's a further structural feature worth isolating. The fictitious debit memos and the inventory inflation both attack the same accounts auditors rely on for cross-verification. An auditor confronted with high gross margins might examine the cost of goods sold. The cost of goods sold was supported by inflated ending inventory, which was supported by manipulated physical counts. An auditor examining amounts due from vendors might request support. The support existed in the form of debit memos, even though the underlying credits were fictitious. The scheme did not leave gaps where verification would naturally look. It populated those locations with fabricated support. The record also establishes that members of the family held positions inside the company that gave them control over the very functions an auditor would test. when the people preparing the records, supervising the inventory counts, and interfacing with the auditors are coordinating the fraud, the auditor's independent procedures are conducted in an environment that has been arranged in advance. The auditor selects a sample, but the population from which the sample is drawn has been corrupted. The auditor confirms a balance, but the documents supporting that balance were created to be confirmed. By the time you assemble the full architecture, the org chart is simple to draw. At the center, the controlling family holding both executive operating roles and the largest equity stake. Beneath them, the inventory and accounting functions, staffed in part by family members or those directed by them. The cash pool offshore available for recycling. The auditors, outside the structure, applying genuine procedures to a population that had been manipulated to pass them. And the public shareholders at the far end, buying stock priced on earnings that the architecture had manufactured. Now the detection failure. Why did this persist, and what would have had to be true for it to surface earlier? Start with the auditors, because the audit is where the fraud was most directly engaged. The record establishes that the inventory manipulations were specifically designed to defeat audit procedures. Count sheets altered after the auditors left. Inventory shifted between counted and uncounted locations. Merchandise moved to inflate totals. These techniques exploit a structural limitation of the physical inventory observation. An auditor observes a count at a point in time. The auditor cannot remain in every store and warehouse continuously. There is necessarily a period between the auditor's observation and the finalization of the inventory figure during which the records can be altered if the people controlling them choose to. The control that addresses this risk is the tracing of test counts. The auditor records specific quantities of specific items during the observation and later traces those exact figures into the final inventory compilation, confirming they were not changed. Where the record establishes that count sheets were altered after the auditors departed, the question becomes whether the auditor's own recorded test counts were sufficient in number and sufficiently protected to catch the alteration. A scheme that knows which items the auditor recorded can avoid altering those specific items while inflating others. The effectiveness of the test count control depends on the auditor controlling its documentation and on the sample being large enough that the company cannot simply work around it. Consider the analytical review. A retailer reporting accelerating same-store sales and expanding gross margins simultaneously presents an analytical signal. Rising sales can compress margins as the mix shifts toward promotional items or expand them, but the combination of rapid revenue growth and improving margins in a competitive consumer electronics market invites the question of what is driving both. The record structure suggests that the margin improvement was the artifact of inventory inflation and the revenue growth was the artifact of reduced skimming and recycled cash. An analytical review attentive to the relationship between these trends and skeptical of their coincidence identifies a question. Whether that question was pressed hard enough against documentary support that had been fabricated to answer it is the detection issue. Consider the cash. The recycling of skimmed funds back into recorded sales means that a portion of reported revenue was supported by cash deposits with no corresponding ordinary commercial transaction. Tracing the source of cash receipts and reconciling recorded sales to independent evidence of customer transactions is difficult in a cash-intensive retail business. which is precisely why a cash-intensive retail business is a favorable environment for this kind of manipulation. The same characteristic that made skimming easy when the goal was to suppress income made recycling easy when the goal was to inflate it. Cash does not carry a counterparty record the way a wire or a check does. There is a more general structural point about the detection environment. The fraud spanned the transition from private company to public company. While private, the company's incentives ran toward understating income, and the record establishes it did so through skimming. The reversal of those incentives at the public offering meant that the very same operation that had been suppressing profits began inflating them. An outside observer who joined the story at the IPO saw only the inflation phase. The understatement phase, which would have provided context, was hidden in the private history and in the offshore cash. The auditors and analysts examining the public company were examining the second half of a maneuver whose first half they could not see. What would have had to be true for earlier detection? The test count control would have had to be robust against post-observation alteration, which requires the auditor to control and protect its own count documentation and to perform sufficient surprise or supplementary procedures that the company cannot anticipate which items will be traced. The vendor credit support would have had to be confirmed directly with the vendors rather than accepted on the strength of the company's debit memos, because confirmation with the counterparty is what distinguishes a real credit from a fabricated one. And the analytical relationship between revenue growth and margin expansion would have had to be pursued past the company's prepared explanations to independent evidence. Each of these is a recognized procedure. The failure was not the absence of controls, but the gap between the controls as performed and a scheme specifically engineered to operate inside that gap. There is a final detection dimension that the record makes structurally clear. The people who controlled the fraud also controlled the company's representations to the auditors. When management is the source of the fraud, the auditor's reliance on management representations becomes a vector rather than a control. The auditor asks whether the records are complete and accurate. Management, which is perpetrating the scheme, affirms that they are. The representation is worthless precisely in the situation where it matters most. This is the structural reason that management override of controls is the hardest fraud risk to address. The controls assume someone honest is operating them. Now, the unraveling. The structure that compounds fraudulent earnings forward is, by its nature, unstable, because each period must exceed the last, and the underlying business cannot grow as fast as the fabricated numbers require indefinitely. But the proximate trigger at Crazy Eddie was a change in control. The record establishes that the company became the target of a takeover. When the new ownership took control of the company, they gained access to the actual inventory and the actual records, free of the family's management of those functions. A physical inventory taken under new control revealed a massive shortfall. The inventory on hand was far less than the inventory the company's records claimed. The phantom inventory that had supported years of fabricated earnings did not exist, and once the people manipulating the count no longer controlled it, the count revealed what was actually there. This is the mechanical endpoint of the inventory inflation scheme. Phantom inventory is an asset that exists only in the records. It can be sustained only so long as the count is controlled. The moment an independent count is performed by parties who are not part of the scheme and who control the conditions of the count, the asset evaporates, and the cumulative overstatement crystallizes as a loss. The lapping had rolled the shortfall forward for years. When control changed, there was no further period to roll it into. The discovery of the inventory shortfall set off the public collapse. The record establishes that the financial statements the company had issued were materially false, that inventory had been overstated, that income had been inflated through fictitious debit memos and recorded sales that did not reflect genuine commercial activity, and that the prior skimming and the recycling of skimmed funds had been concealed from auditors and investors. The Securities and Exchange Commission brought enforcement proceedings. The record of those proceedings establishes the mechanisms: the inflation of physical inventory through altered counts and double counting, the fabrication of vendor credits through fictitious debit memos, and the manipulation of reported income across the private to public transition. Trace the sequence with precision. First, the controlling family took the company public on financial statements that presented inflated and rising earnings. Second, the family sold stock at prices supported by those earnings, realizing value from holdings whose worth had been increased by the fraud. Third, the takeover transferred control to outsiders. Fourth, the independent inventory count under new control exposed the shortfall. Fifth, the public financial statements were revealed to be false, the stock collapsed, and the company entered the path toward failure. Sixth, the enforcement and legal process established the conduct on the record. The structural logic of the collapse is worth holding precisely. The fraud generated value for its operators at the moment of sale, when stock priced on fabricated earnings was sold to the public. The loss was realized by the buyers and, ultimately, by whoever held the inventory account when the count finally came up short. The takeover was the event that forced the count out of the family's control, but the shortfall it revealed had been accumulating across every period the inflation had run. The new owners did not cause the loss. They discovered it. The loss had been embedded in the records all along, masked by the manipulation of the one control that could have revealed it. What does this case establish about the mechanism? First, it establishes that the physical inventory observation is not self-executing. It is a procedure performed by people under conditions, and those conditions can be manipulated by a company that controls its own premises and its own staff. The auditor counts what is there at the moment of observation. The integrity of the resulting figure depends on the auditor controlling the documentation of the count and on procedures that prevent the company from altering the records afterward. Where management controls the inventory function and is willing to alter counts, the observation alone is insufficient. The control must include protection of the auditor's own test counts and direct verification of the populations from which samples are drawn. Second, it establishes the structural significance of vendor confirmation. The fictitious debit memos worked because they were accepted on the strength of the company's own documents. A credit claimed against a vendor is real only if the vendor agrees it is owed. Confirmation with the counterparty is the procedure that distinguishes the two, and it is the procedure that a fabricated debit memo cannot survive. The case is a demonstration that income supported only by the company's internally generated documents is income that has not been verified. Third, it establishes the danger of the private to public incentive reversal. A company that suppressed income while private has, in its history, the cash and the practices to inflate income when the incentive reverses. The skimmed funds became the fuel for the recycling. An examination of a newly public company that does not account for what the company's incentives were, while private examines only half of the picture. The historical pattern is part of the risk assessment. Fourth, and most fundamentally, it establishes that inventory is the junction where the balance sheet and income statement fraud become a single fraud. $1 of phantom inventory is $1 of phantom profit. The control that protects the inventory figure therefore protects the earnings figure. When that control is defeated, both statements are false together, and they are false in a way that is mutually reinforcing, because the inflated inventory makes the inflated earnings look plausible. The Crazy Eddie record entered the literature of audit practice as a case study in management override and in the manipulation of physical inventory observation. It is taught as an example of how a coordinated scheme attacks each audit procedure with a specific countermeasure, and of why the detection of management fraud requires procedures that do not depend on management's honesty. The findings are not a verdict on the people. They are a description of a machine: cash taken out, cash fed back in, inventory inflated to match, account manipulated around the auditors who observed it, and a shortfall rolled forward until the period it could no longer roll into arrived. That is the forensic finding. The store restocked its own shelves after the auditors left, and for a number of years the number held.